What the heck is going on with my hair today? Good day, subscribers. Thank you so much for joining me today. I am Jeremy. This is the Financial Education Channel, and today we're talking about 10 potential multi-bagger stocks. Now, what does it even mean to be a multi-bagger stock? That means a stock that will at least double. And I'm talking about in the next 3 or 4 years, I expect all 10 of these stocks to at least double, or at least there's a high probability of them doubling, in my opinion, with these 10 stocks. And to make it even more interesting, I took out any of my stocks. So any stocks I personally hold as investments, me personally right now, I did not include any of those. So any of the stocks, 4 stocks I'm buying, I did not put any of those in this list just because I didn't want it to be the same stocks. 4 of the same stocks, and then I only got to come up with 6 new ones. I had to change my whole entire research, guys, and do 10 brand new stocks. So I hope you guys enjoy this today. Leave a thumbs up if you do, and let's get right into this. The first one is Apple. So why could Apple potentially more than double within the next 3 to 4 years? Well, with Apple here, we got a company that has a forward PE of around 14 right now, guys. 14, that's well under what the market is trading at. And this is also one of the safest companies out there, literally in the world, to invest in as far as if you're looking out in the next 5-10 years. So it's trading at a discount to the market, and it's a relatively much safer company than most companies out there, right? So why else is this one other than just a 14 PE? Well, if you look at the balance sheet, this company has over $18 billion in cash. They have over $58 billion in short-term investments, and they have over $184 billion in long-term investments. Now, what does all that mean? That means they're going to be using massive amounts of that money to basically up the dividend, which will attract even more investors, but mainly for share repurchases. When you do a share repurchase and you're buying your own shares back, those shares get off the market, right? So if your share price is the same exact and your earnings are the same exact, your PE ratio would still come down because there are less shares to go against whatever you're making for earnings, guys. So which means your PE ratio gets even lower, which means you're even more and more profitable company. Now, it's not just that Apple's earnings, I think, will be stagnant. I think their earnings are actually going to grow. So when you're buying back shares and your earnings are growing, that is a phenomenal sign for your company, and that attracts even more investors. Now, why are earnings going to go higher? Well, because of iPhone 8, basically. The new iPhone, this is going to retail somewhere around, they're talking about close to $1,000, guys, close to $1,000. This is not just going to be an iPhone thing. The next Galaxy Note phone, the Galaxy Note 8, this phone is supposed to retail somewhere around $850 they're talking about, maybe even upwards of $1,000 for some of the higher end models for the Note 8. So all iPhones, the premium iPhones, are all going to start approaching $1,000 now, guys. And it's not going to stop there. There will be a day, not that long from now, maybe about 4 or 5 years ago, when we'll be paying $1,200, $1,500 for the average smartphone, and that will just be a normal smartphone at the end of the day, guys. Why is this all going to keep going up and up in price? Well, because the phone has become the most important item for humans. It's more important than people's cars now, because at least you can get an Uber on your phone, right? The phone has taken over as the most important thing in people's lives. So when I hear an analyst say, oh, people aren't going to spend $1,000 for phones, they don't really understand how important a phone is. It's literally the most important thing in anyone's life. Literally, as far as an actual object, is more important than anything for pretty much every person out there. So this whole, consumers will just pay $600 or $700 forever. Absolutely not. When you're talking about people pay, $1,000, $1,500, $2,000 cash for a MacBook or any computer, right? And those aren't even as important as a phone. The phone is far more important than my laptop. Like if you said, Jeremy, you can keep one thing. It's either your phone, your iPad, or your computer down there. I'm keeping my phone at the end of the day because the phone is a lifeline, guys. So the phones are going to be more expensive, which means more and more profits for Apple at the end of the day, and basically Samsung as well, and Google, because the Google Pixel will be $700, $800, $900. They're all going to go up and up in price, and that is going to make the company even more profitable. And the great thing about phones is you don't really pay cash for a phone. You pay on a payment plan, the similar way to like buying a car, for instance. You pay a monthly payment, and maybe your monthly payment goes up $30 a month or $40 a month. People don't even notice it, guys. People don't even notice it when they buy a new phone because it just gets put on the payment plan, and it's going to be an extra $30 a month. Oh, I can afford that, and they do it. So that is the main reason with a low PE ratio, with how many shares they're going to be buying back, with how much they'll up the dividend over the next few years, which will attract even more investors. And then you got iPhones, which is their main product that drives the company, right? Going up and up in price, and you have services exploding. We know that the revenue in services is going up 20+% a quarter, and that's like a pure profit engine for Apple. Between all those things, over the next 3 to 4 years, I absolutely believe Apple can at least double, which will put it well over $1 trillion market cap. It'll put it around a $1.5 trillion market cap in about 3 or 4 years from now, and I can absolutely see that, guys. So that is the first one. The next one up here is a much smaller company. I tried to get a list of a lot of different companies. This one is called Del Taco. They have a market cap around $500 million. This is a little teeny company, guys. A PE ratio somewhere around a 22, on a forward basis around a 19 or 20 right now. If you're familiar with this chain, they're similar to like a Taco Bell, except in my opinion, they're probably a little better quality, and they're actually a little more underpriced, in my opinion, than something like a Taco Bell. And that's their business at the end of the day. Now, why do I like this company so much? Well, because they're at a company in expansion mode right now. They're expanding restaurants, but not just that. If you look at their comparable store sales, their restaurant sales growth, 7.1% and 6.9%, guys. This is phenomenal growth in restaurant sales here. We look at system-wide comparable restaurant sales growth of 7.1% and company-owned operated comparable restaurant sales growth of 6.9%, marking the 15th and 20th consecutive quarter of gains. When your restaurants have more and more sales, that goes more and more to the profit at the end of the day, guys, because there's a certain amount you need to be doing in sales to basically make your bills when you're running a restaurant, right? Everything after that point is much more of a profit engine than it is just revenue coming in the door, because everything else coming out, then you're just taking out your food costs, and your labor's generally there no matter what. So no matter whether Del Taco sells 1,000 bean burritos or 2,000 bean burritos, they'll probably have about the same amount of labor on, no matter what, because they still need people on the line. It's just the difference is there might have been a lot of time wasted before where people are just standing around waiting for orders, and this is every restaurant in general. This is just the way the restaurant industry works. But when those people are busy and they're constantly working, that's when your profitability begins to absolutely explode, guys. So this company absolutely has a great chance to double over the next 3 to 4 years. And you look here, they basically upped all their numbers. So system-wide comparable restaurant sales growth of approximately 3.5% to 4.5% they're expecting now. Previously, they were expecting about 2% to 4%. Total revenue between $470 million and $476 million. They were previously expecting 466 to 476, guys. Very well-run company at the moment when you have same-store sales growing at what Del Taco's growing. So this company absolutely has a great chance to double over the next 3-4 years. Next one up here is eBay. So what do I like about eBay? Well, this company has a forward PE currently of 15, guys. The reason it's a 5 from last year is basically because of the PayPal split off there. But on a forward PE basis, it's basically around a 15 right now for this, guys. Now, what I like about eBay is we know eBay from the auction side. We know that's the place to go if you want to buy something used, right? But the big thing eBay has been pushing the last few years is getting to a place where they're the cheapest actually to buy regular products, like new products. And I did a little test here I'm going to show you guys, and eBay is killing the competition in price. And as word of mouth gets out about this, I believe this will push up eBay sales to record highs, and this will push the company's stock to record highs and things like that. So let's look at this here, guys. I basically just typed in the camera that you're watching this on. It's a Canon 80D. So on Amazon, this is a body only. On Amazon, they charge $1,199 if you want to buy that camera. On Best Buy, they charge the same price, $1,199. On eBay, and this is new, this is the same exact thing you'll get on Amazon or at Best Buy, fresh out of the box, $904, guys. eBay is beating them by $300. $300. It's not going to take time. It's not going to take a lot of time for word of mouth to spread about, wow, eBay is a place to go shop. I looked at another popular product, GoPro's top selling product, the GoPro Hero 5 Black. Amazon sells it for $399. Best Buy sells it for $399.99. And guess what? eBay underprices them both by $10, $389. Let's go ahead and look at the most popular selling drone in the entire world. What is it? The DJI Mavic Pro. Amazon sells it for $975. We have Best Buy selling it for $999, and we have eBay selling it for $949. They beat everybody. So I think between what eBay's doing for branding, I've seen a lot of their commercials on TV, they're doing a lot more of rebranding of eBay, and between them being able to beat Amazon and everybody on so many prices, guys, like it's not just electronics, like you can look in so many different categories. eBay is killing the competition. So I think that will really eat up into sales, because retail, a lot of times at the end of the day, what does it come down to? It comes down to price on a lot of these things. Am I going to go and pay an extra $300 for a Canon 80D at Amazon or Best Buy, or am I going to buy it on eBay? It's the same exact product. Obviously, I'm going to buy it from eBay. And by the way, I did buy this one on eBay. So I'm always looking for price. Like, I'm not just going to spend an extra $300 just to spend an extra $300. So the word will get out. This will start to spread. And when you're already at a low PE, like a 15 forward PE, this is a company that could absolutely double, in my opinion, or more than double over the next 3 or 4 years, as long as they keep executing. Next one up here is, a lovely one, Snapchat. This is a highly controversial stock right now. A lot of people bullish on it, a lot of people bearish. Why could Snapchat double within the next 3 to 4 years? Well, this is a company that has around 173 million daily active users currently. 173 million. That compares to Facebook, which has about 1.3 billion daily active users. And when you count up Facebook, they're counting up the Facebook platform, they're counting up Instagram, they're counting up WhatsApp, and they're counting up Facebook Messenger. So all the Facebook products. So basically, Facebook has about seven times the amount of daily active users on their platform versus Snapchat, right? But Facebook has a valuation of over 30 times the valuation, because Snapchat has a valuation of somewhere around a $16 billion market cap, whereas Facebook has around a $486 billion market cap, guys. So Facebook has only about 7 times the amount of daily active users right now on the platform, whereas it has 30 times bigger market cap. And Facebook gets that market cap basically because they're a lot further along. Their services have been around a lot longer than Snapchat has, and they've rolled out their ad platforms much quicker and much better than Snapchat has, where Snapchat just really started monetizing in a real way this year. So what I like to look at here with Snapchat is you can see the quarterly average revenue per user, otherwise known as ARPU. It's around $1.05 this last quarter compared to the previous year at 50 cents. So it well over doubled. The average revenue per user over doubled, guys. However, you look at the hosting cost per daily active user is around 61 cents versus last year was around 55 cents. So we can see cost as far as the hosting costs, I guess you could say, versus what the revenue's going up per user, guys. It's a drastic difference. There's a drastic difference, and it's a better thing for Snapchat. So you can see within the next few years, Snapchat can absolutely get to a point of profitability, and they should get to a place where they have about 250 million daily active users within about 3 to 4 years, guys. As long as they keep, clipping around and getting another 30 million per year or somewhere around that number, guys. So this is definitely a stock that has a phenomenal chance to at least double within the next 3 to 4 years. Next one up here is Goldman Sachs. Goldman Sachs, this stock, this is the best run investment bank in the world, in my opinion. It's got a forward PE of 11 right now, guys. 11. Now, this company just blew numbers out this past quarter, right? EPS came in at $3.95 versus $3.39 was expected. Revenue came in at $7.89 billion versus $7.5 billion was expected. So, this is a company, when you have that type of PE ratio, a forward PE of 11 and a trailing PE of, under 12, you're talking about a company that's severely undervalued in a market like we're in right now, guys. So Goldman Sachs absolutely has a phenomenal chance, just based upon valuation metrics and how much earnings should go up over the next few years, that it almost has to double, just because of look at what kind of market we're in. We're in a market where most companies have forward P's over 20. This one has a forward P of around 11. So for valuation reasons, based upon what their earnings should go up over the next few years, this one should absolutely at least double over the next 3 to 4 years. Next one up here, guys, is Zillow. Zillow, you guys have probably used this if you ever looked for a house before, you ever looked for a house to rent, buy, anything like that. Zillow, this company just reported record numbers here. So they're doing $266 million in revenue for the second quarter, a 28% increase. If we look here, look at how much they've grown revenue over the last few years. I mean, they were doing $66 million in revenue in 2011, and now they're doing possibly over $1 billion this year, guys. Over $1 billion. Absolutely phenomenally growing company. So this is a great growth company just in general, but what I really like about it is there's this new little feature they have that's going to be a huge feature in the future, guys. It's called Zillow Instant Offers. Sell your home fast. Competitive offers. Receive multiple no obligation offers from investors based on your home details and comparative sales. You can choose your closing date, no prep necessary, free professional valuation. You don't even have to use a realtor if you don't want. How it works, you share your home details, snap some pictures, you get multiple offers from different investors, you can connect with an investor, you schedule a free inspection, and then you can close on the deal, and you don't even have to use a realtor if you want for this, guys. So what does it cost? There's no cost to receive Zillow Instant Offers, so that's a pretty good deal. You get to put it on there for free, your home. But if you decide to sell your home, you will receive a clear statement outlining all the fees associated with selling your home to an investor. So this is a big thing here, guys, and I think this is something that could potentially hurt a lot of my customers in my real estate business, to be honest, because you don't even have to use a real estate agent. You could just be living in your house and post some pictures on it and say, you know, what are some offers? And then if they have the offers, if you get some offers and you like that offer and you're, you know, pretty decently well educated on what your home's worth and you want to sell it, you can sell it right through the Zillow platform, guys. And Zillow makes a big commission on that versus usually a realtor would make a commission on that. So we could potentially be looking at a situation where massive amounts of sellers in a few years, as this gets rolled out bigger and bigger and, you know, it spreads and the message spreads about this, we could be looking at a situation where a lot of sellers aren't even using realtors anymore. They're just kind of, you know, doing it through the Zillow route. So that's a big thing, and you can add up the transactions, you know, on say they're getting a 2% fee on, you know, a $300,000 house, guys. That's big money. We're talking big money, and then imagine, you know, all the different states all around the country, and imagine all the different territories that are in around the world, guys. And they own Zillow, they own Trulia, the two biggest apps used, and they own realestate.com. So they're in all the main platforms you want to be in if you own the real estate platforms at the end of the day, guys. So that one could absolutely double within the next 3 to 4 years. Starbucks is the next one up here. So Starbucks, this one has a forward PE of around 22 right now, which is about, you know, what most stocks are trading at. Why can Starbucks at least double within the next 3 to 4 years? Well, one is they're pushing big into the food game. This should push up average ticket prices from somewhere around a $5 to maybe a $10, somewhere around there, guys. As they get better and better at food, as people get more and more used to buying food there, then you maybe used to go to McDonald's to get food, and then all of a sudden you're starting to get Starbucks. So Starbucks is pushing the food game, and this is just a great way to increase sales at Starbucks, because it's, you know, until a few years ago when they started rolling this out, right? You literally couldn't buy real types of food from Starbucks. Like you could get a pastry or something, but you couldn't get, you know, an egg sandwich or something like that. Now that Starbucks is rolling this out, that's a huge growth opportunity for them. Then you have the Starbucks Reserve stores. Starbucks Reserve stores, these are just massive Goliath type beast type places, guys, where you can have a whole different kind of experience. These are multiple floors. These are just, you know, where the average ticket price of one of these Starbucks Reserves is somewhere around a $20 range. It's more like a super high-end restaurant type experience than a normal Starbucks experience where you walk in a store, order your coffee, and walk out. This is somewhere where you hang out for hours, guys, almost like the modern day bar, but in Starbucks terms. And then the last thing here that is going to fuel the company as far as growth goes is Starbucks plans to add over 10,000 new jobs a year in China over the next 5 years as part of the U.S. coffee giant's big bet on the nation of tea drinkers. Besides aiming to more than double its store count in China to 5,000 by 2021, the world's largest coffee chain is brewing up a 30,000 square foot premium coffee house experience in Shanghai, like we just talked about, guys. So they're going to over double the amount of stores in China. That's going to push up, profits and revenues to all-time highs, and that will just make the Starbucks name a lot bigger in China. So maybe it'll even help out some of those older stores that maybe, somebody would walk by and like they don't even know what a Starbucks is, but now it's in this market or that market. Big things for branding there, guys. So Starbucks, absolutely a company with the food game going, with the reserve roasteries going, and then with the China growth, this is a stock that could easily double within the next 3 to 4 years. Next one up here is Facebook. So this one right now has a forward P of around 25, guys. A forward P of around 25. Last year, they're basically a trailing PE is around a 42. So they're going from a 42 to 25. So this is a fast growth company as far as profits go. You look at their revenue here. So their revenue last year went up roughly around $10 billion, right? But their profits went up roughly around $7 billion. So 60 to 70% of the new money coming in, guys, going straight to that bottom line, So they're at a 25 forward P. The next year that should push it somewhere around a 16. And then what is it going to be the next year? If the stock didn't go up again, then we're around 11. So this is the type of company that it absolutely needs to keep going up because it's got to keep up with that forward P, because even though I believe Instagram growth will slow substantially over the next year, so starting in 2018, I believe the monthly active user numbers and the daily active user numbers as far as growth will not be very good. The amount of advertisers still coming on the platform, guys, that's a phenomenal growth engine for years to come with Facebook. So this is a company over the next 3-4 years that could absolutely double, and that would put it somewhere around $1 trillion market cap, guys. So this absolutely has a phenomenal way to get there. Next one up, this might be the most controversial of all of them. This is a company named Fitbit, one of the hardest hit stocks in the market, guys. A $5 stock now. It's got a $1.2 billion market cap, but this company has $318 million in cash, another $357 million in short-term investments, and guess what? They have about no debt on that balance sheet. So essentially, if you're buying Snapchat shares right now, you're buying them you're basically paying about $500 million for the whole company when you exit out what they have in cash. You're basically paying about $500 million for the actual business, guys. Now, with Fitbit, it's not like they need to start killing it again, and have crazy high numbers and whatnot. They just need to stabilize this business in 2018. They just need to stabilize the business, get back to profitability. They don't have to kill it. When you have a valuation as low as Fitbit does, you don't have to kill it. You don't have to, have revenues going up 30, 40, 50% and profits exploding. They just have to stabilize this business in 2018 and get to a place where they're eking out small profits and whatnot in 2018, and then build on that in 2019, build on that in 2020, and you could easily have a stock that doubles when it has the type of valuation this one does. And they have something big coming here this fall. Fitbit's Apple Watch competitor seen in renders new sensors could offer better vitals tracking, guys. So this is a company that's coming out with an Apple Watch competitor, and this is something that could potentially push the stock, way higher than I'm even talking with a double. But that's if it's a big hit. I would never bet on something being a big hit with an electronics company, because you never know if something could go wrong and those kinds of things, or maybe the market just doesn't take it well. But it should be a decent selling product. It should move to its number one new product, right? And when you're talking about that, as long as they can manage inventories well and they don't take huge write-offs from the Best Buys and those type of places, they manage inventories well, they should be able to make nice profits on that product. We look at the latest quarter here, and I think they're already starting to move slightly, to the way of profitability. You look at the loss per share, they took an 8-cent loss per share, but they were expected to lose 15 cents. So they came in way better than expected. Revenue also beat theirs, $353 million versus $341 million was expected. So they're already starting to stabilize a business, and that's a very good sign when you look at this stock and we look at how low the company's valued. So this is one of those, as long as they can stabilize this business and just start, eking out a 5-10% type revenue growth number and, be profitable, make a $50 million profit, a $75 million profit. This is absolutely a company that could double or even much more than that if they can find a hit product in the next 3 or 4 years. And the last one here, guys, is a company named Micron, otherwise known as Micron Technology, ticker symbol MU. This one has a forward PE of 5. A forward PE of 5. Yes, you heard me right. They're in the memory business. They're in the memory business, so they have memory in a lot of your phones you may have, a lot of different devices. They probably have the memory chip in this iPad. I don't really know. I haven't looked into it, but that's the type of business they're in. They have a forward P of 5, guys, a trailing P of 13, forward P of 5, super low valuation company. So, and memory prices are pretty stable right now. So this is a type of company that could easily double within the next 3 to 4 years, not even if it has growth, just because of valuation reasons. You can't keep this company at a 5 PE forever. It's got to raise unless the business completely falls apart. And because memory chip pricing is pretty, I guess you could say, safe right now, it's not like it's in a big downward move. For valuation purposes, kind of like a Goldman Sachs, this one could absolutely double just because it's such a low valuation on the company currently, guys. So those are 10 potential multi-bagger stocks. Let me know in that comment section if you like any of these 10, if you don't like any of these 10, if you are actually invested in any of these 10. I would absolutely love to hear from you guys in the comment section about this, guys. Other than that, check out my book. It is linked in that description. It's the first thing linked there. All that goes into, how I judge a stock and how I fully value a stock. That's what we talk about on there. It's now back out on paperback, so I hope you guys enjoy that. If you just came across this channel, you may want to subscribe. We talk personal finance on the channel. We talk entrepreneurship. I'm an actual business owner. I give away so many business tips. We talk stock market investing more than anything. Thank you for watching, guys, and have a great day.